You have helped so many families figure out what they should do with their investments, and more than anything else, demystify complex issues and, not be scared of the numbers. I mean, most people who don't know much about it are just wondering, how am I going to lose all my savings now? And this is not a war that I signed up for. There's an article for viewers and listeners, there's an article by Monika in the Hindustan Times, which you can read, about just this. What do I do? How do I cope with this? But otherwise, you can listen to this conversation too.
More better.
Better. So that's why I'm asking you. It feels now for small investors that whatever I've put in, I'm going to lose it all. So explain to me this anxiety. Is it justified or is it hyped? And how would you calm this down?
We could have had the same conversation several times in the last 6 years, because 2020 has been a devastating decade. Okay, and we are not over yet. We've got 4 years of this deadly decade left. I've had the same conversations during COVID. I've had the same conversations around every new crisis. Ukraine-Russia war. Exactly the same things. So obviously the people who are feeling anxiety about their money in the markets are doing something wrong. Because if you are anxious about your money in the stock market, it means you've not followed the rules of investing in markets, because investing in the stock markets requires some rules that you follow. You do not swim in the deep unless you've learned to swim in the shallow. So if you are getting anxiety right now, you've just not followed a basic rule which is called diversification. Okay, these are all jargon words, but it just means that when you eat a meal, you're eating carbs and proteins and fats and minerals and greens. You've diversified your thali, right? That you don't just stuff rice.
Yeah.
You eat diversified nutrients. Your portfolio is exactly the same.
How nice. Okay, you explained that very simply.
Okay.
Huh?
So, you eat carbs for instant energy, you build proteins to build muscle. You have safe products which are fixed deposits, debt mutual funds. Okay, mutual funds also invest in debt, which is bonds. You have things like the Public Provident Fund. You have all the government guaranteed zero risk products that makes up your safe investing basket, right? This is the money that you have for your near-term needs, other than things like PPF and all. Of course, fixed deposits you can break. Debt funds is overnight money you get back. These are low-risk products you have as a sort of a moat around you.
Okay.
This is money you need in the next 3 to 5 years. You do not invest in the markets unless you have at least 7 years horizon. This is money you don't need for 7 years at least, because it takes about that much time for anything to get through. Right? So in COVID, what were the markets at? I think around 35,000. I think they had dropped to some, Sensex had dropped to 29. So let's say 35,000. Even after this, what is it today? It's around 70,000. Has it doubled or not? So if you were invested then, has your money doubled over this time?
That's if you have a long-term vision.
Only then should... don't go to the deep if you cannot swim. So please, you do not have to be in equity if you don't understand markets, if you're not following basic rules of having at least 30, 40, 50% of your money in safety, and the rest is in equity, which is long-term risky products. Okay. So this anxiety really comes from people who've not learned how to invest in markets.
Okay.
And nobody is forcing you to invest in markets. Don't do it if you don't understand it.
Yeah.
There are some rules you have to follow. Your basic rule is asset allocation, which is how much do you have to keep in safe debt, fixed deposits for money that you need now, and how much can you afford to keep growing, okay? How much can you leave for growth? That's your basic allocation.
So only play with that.
I don't even use words like play.
Okay.
Because for me, it's a rule-based way to do hands-free money management. I don't even look at markets. मुझे नहीं पता so the headlines will come. I'm completely disinterested as to tomorrow's Sensex value. It doesn't matter to me. Unless you're in this space, you're always going to be, your heart is going to be palpitating every time the markets drop. So you have to follow a rules-based way to invest in equity markets. And for people who don't understand markets, you just stay with something called an index fund, which is like your lowest risk way for long-term growth.
Which is what you advise people in these fluctuating
No,
geopolitical
no,
situations, or always?
No, so if you don't understand markets, it is indexing for you. If you understand how to choose, then you can do active funds. I will strongly recommend that you don't pick stocks unless you have the time, knowledge, bandwidth to follow a single stock or 5 stocks across time. Everybody has day jobs. How are you going to look at one stock, what is happening there, right? I have very simple money rules. Do what you understand. Do it so that you don't have to look at your portfolio every day, every week, every month. I will open mine twice a year. I talk about money, but I don't think about my money.
What if you have somebody else to do it for you and that person is not following it properly?
Then you have the wrong person.
You have the
don't
wrong
do
person.
it.
Okay.
Absolutely, you have the wrong person.
Khud karo.
Phir sirf
Managing
indexing karo, yeah. Then you just
Indexing.
read like, let's talk money, let's talk mutual funds, and you just follow the rules.
Okay.
It's if you want to do it yourself, then you keep it even more simple. Okay, if you're doing equity for the long term, just stay with an index fund. And remember, there are like 2,000 index funds. You have to learn how to even use mutual funds before you get
is it
into
that
it.
people are misunderstanding the volatility of the situation right now?
I think they get taken in by the desire to make quick gains, and they look at the stock market as a place for gambling, which it is not. There is a speculative part of the market that's for traders. Traders and speculators are very important to the stock market. So I think I'll ask a very basic question. Who are you?
Yeah.
Are you an investor or are you a speculator? If you're a speculator, my God, you're playing with the big boys. So you better be you should have deep pockets. You should have the smarts to play with the best minds and technology in the world. If you're an investor, you please don't speculate. Then you do long-term
When you
equity.
say investor, you mean say medium or small level, say 10, 15 lakh wala investor.
Yeah, you could be that. You could be absolutely 10, 15 lakh, 10, 15 crore. It doesn't matter. You could put what. So you have to decide at whatever. So what I tell you is applicable to you at whatever stage you are at. Your fundamental thing is, am I gambling or am I investing? If it is investing, then your heart should not sink when
But
markets
is
go
it
up and down.
20 to 30%.
Yeah, that's fine.
Depletion of the portfolio. It is sinking then?
So
Heart is
that is
sinking.
where your asset allocation comes in. So people who follow this, and in fact on Twitter we've had this big, in fact I'll talk about that right now in a minute. So this rule of asset allocation, right? So let's say you have 100 and 40 rupees is in fixed deposits, debt funds, and 60 is in equity. Okay. If you just maintain this portfolio, so suppose equity, when there's a bull run, from 60 goes to 80, okay, because markets have gone up. That's the time you rebalance and come back to 60-40. So you've booked your profit, you've bought more debt. So if you've maintained your allocation, then this 30% drop is like a 7% drop or an 8% drop, because you're looking at your entire portfolio, you're looking at your whole thali. You're not just seeing that chicken prices have gone up, so my chicken consumption is going down. You're looking at your entire thali. There is enough food on the plate. So what you need to do is calculate what is my portfolio return. I have 100, and you can do whoever's watching, do your own numbers. Let's say you have 100. In that 100, how much is safety and how much is risk? And then you look at the average annual growth rate of this. Whoever is following these rules today, even after a 20% drop, I don't think is looking at more than a 7-8% drop in their portfolio.
Oh, okay.
Yes, that's the joy of asset allocation. That the role of your debt is to keep your entire portfolio from crashing. What it will do is when markets go on a bull run, it wouldn't give you those highs that other people will see. So yoga karna hai thoda, balance mein raho. So your lows are not so low, your highs are not so high.
Okay.
It's like that.
But that's for people who like that, what should I say, a steady way of doing things.
So if you don't like steady, then don't cry. तो फिर क्यों रो रहे हो? Then you are jumping into the deep end. You sink or swim.
What is it that you were saying? Social media mein.
So I for years I've done this experiment. Okay, I like to do numbers. Okay, it's like data nerd. क्या कर रहे हो? अच्छा Excel sheet देख रहे हो? Like you should watch a movie or something. But yeah, like abnormal people.
Give me Durandar instead.
Yeah. So abnormal people look at data.
I guess everybody has their safe zone or their comfort zone, and yours is numbers. Okay, interesting.
And this is a conversation I've had so many times. Markets are unsafe. I'm saying, no, they're not unsafe. You have to know how to. Okay, so I said, okay, let's say, and people will also have this thing. Okay, they say that I invest and markets fall down. Okay, they think that I'm unlucky. They are unlucky. And I just think that they're giving too much importance to themselves, because market doesn't care about you as an individual. Right?
True.
It cares about all of the information in all of the economy in the world. You're nothing. You're like the speck in the universe. But there is this like, maine kiya aur dekho market gir gaya. So I said, okay, let's say there's somebody who's the unluckiest investor in India. Okay, so there's a calendar year, 1st Jan to 31st December. It's 52 weeks, right? So jargon, I'll give you some jargon. It's called the 52-week high. मतलब एक साल में उस दिन पे market was at the highest point on that day. Okay, so there's a 52-week low also. But let's say there's this person and he's investing every year 1 lakh rupees on the 52-week high. For that year, that was the highest point. Uske baad market gira. Us saal. That year it fell. But then he's persistent, so he comes back next year and he puts in 1 lakh. And I've taken Sensex, okay, because that's the broad market index. People understand it. We can do variations, but let's keep it simple. अगले साल भी उसने 1 lakh rupees डाला. उस साल के 52-week high पे he happened to invest and markets fell. This guy does this for 35 years. Every time that he puts in 1 lakh, the markets fall for that year. 35 years, he's put in 35 lakh. What do you think that value will be today after 35 years? So the value of that money is around 3.2 crore, okay, on today's. So that 35 lakh has grown to 3.2 crore. If I do, there's something called the total return index, okay, which is actually better, but I'm going to keep it simple. On that total return index, which is the right index to use, it's about 5 crore.
Okay.
So all I'm saying is the unluckiest investor
has made that much.
Has made between 3 to 5 crore over a 35-year period. You are not going to be the unluckiest investor. You're probably going to do every month investing. You've probably done far better. So the idea of taking a long period of time is to say that, look, these are not investments you get into and get out of. These are trees that you plant, you pluck the fruit, and you allow the tree to keep
But if
growing.
you had done it in FD, what would have happened?
The FD returns would have been far lower. So that,
Yeah.
it'll be far lower.
If you had done it in property, if you had done it in gold.
Yeah, so the problem with property is that it's like picking a stock. You bought a flat, you bought a something. So you've got to, like, what did you buy it in Gurgaon or Faridabad? That would have made all the difference. Did you buy a park facing or a drain facing? So property investing is a very, it's a
I'm
very
deviating,
clunky,
but I'm just saying that.
So gold right now is a anomaly because of geopolitics. We don't know how long this up lasts.
Yeah.
Right? Because see, gold
And even while you're saying up and we broadcast it, it could be low.
Yeah, so gold in of itself has no value.
Yeah.
Okay, these are very counterintuitive things to hear. There is a traditional memory of gold being what we call a medium of exchange and a store of value. It stores value, right? The reason that gold is an asset is because central banks across the world keep it as a reserve. So what is a reserve? A reserve is, so India wants to trade with Germany. So I cannot give my rupees. I will either use dollars or euros or
Pledge gold.
I can also, finally we had pledged our gold. You have to have something that is of value to another country, which is not rupee. Right? So every central bank, like we have RBI, then you have the Fed, you have central banks in every country, they keep a part of their reserves as gold. That gives it value. So till the time that central banks are buying gold, the gold prices will keep rising. Please keep a lookout for the news that central banks are selling gold. That means gold prices are going to start falling. So again,
we'll go to gold later.
So average
come back to
annual
this.
return on gold is around 9% minus this one blip right now. Okay, and on the equity markets, it's around 15% if you take the total return index.
Like, the reason I'm asking you is that many people are now nervous with the way the markets are behaving and wondering, should we exit the markets completely till the war is over, like with the Ukraine situation, like with the COVID situation?
Don't do it.
Should we exit it? Should we stay and wait and watch?
Don't do it.
What should we do?
Don't
exit.
No, if you've done it the right way with your asset allocation in place. Okay, I'll tell you a COVID story. So, COVID happens and markets had completely crashed that time. Sensex today is around 71,000. COVID, it had gone down to 29,000. Okay, so it was a 30% drop. And I was in Mint that time. And there was this whole conversation in the newsroom, right? That FDs have given better return. So and there was one person so I was seen as the person who's the markets person. He says, "Ye to bilkul bakwas what you've been telling. I'm selling everything, all my mutual funds." I said, "Don't do it. Please don't do it. Just don't do it. It's a scam. Sab bakwas hai." Gentleman sold it. And then after June, the markets, because finally, see, you have to understand, a market is not a gambling den. What is it reflecting? You have companies which make goods and services, which list on markets to sell their shares, and as an investor, you are participating in their profits and growth. So, could we have said after COVID that everything would stop, we'll not eat biscuits, we'll not consume telecom, we will not watch OTT.
Consumer products, services, whatever, hotels.
Yeah. So are we going to go back to wheelbarrows and caves?
Yeah.
Or is the economy going to continue?
But at that time, it was like, put everything in pharma and nothing else.
No, don't do that. That's what I'm
during
saying.
COVID, that was the talk. Defense nahi hoga because there'll be no more wars.
No, so that's not how you invest. That's how fund managers think. Even they don't do these calls of abhi pharma karenge, and you do it after the bull rally is over.
Yeah.
So your best, and it's not just me, the best money minds, Warren Buffett, Peter Lynch, Ashwath Damodaran, if you listen to them, they are saying the same thing over and over again. As a retail investor, please don't take these calls that you take all your money and you put it into pharma. Now you're putting it into defense. Don't do that.
Okay.
It can be a achar. It can be a return kicker. It can be 5% of your portfolio. Your biggest power is your portfolio construction.
Okay.
Where there is safety because of debt and there's safety because of an index investing that you're doing in markets. Now you want an achar, you want a taste kicker, return kicker. Now you get 2%, 3% of your portfolio as whatever flavor you want to do. Defense, pharma, whatever you want to do. So it's a thin slice.
So net, don't exit with anxiety right now.
No,
Calm.
Absolutely not. If you've got your asset allocation in place, do not exit at all.